Speak to Hans Goetti. He is Chief Investment Officer at Finaport Investment Intelligence Asia. Hans Goetti, thanks very much indeed for joining us. Morning to you. Well, what do you make of that data that we did see, we saw on Friday? I mean, it was a horrible number here. I mean, what does it tell us about the US economy? I mean, are we on the verge of it stalling, essentially?
Well, we have been maintaining for quite some time then that the U.S. economy is not half as strong as some people believe it is. And this is just a confirmation that without fiscal and monetary stimulus and heavy government support, the economy is not able to stand on its own 2 feet. And it's going to be very interesting to see what's going to happen after QE2 is ending. In fact, more and more people are now talking about QE3, something we have mentioned 2 months ago that we think it's very likely, and we still think it is. So in one form or another, the Fed will probably have no choice but to come up with another liquidity program.
Hans, though, I mean, if we have another round of quantitative easing, people are going to raise the question, surely the medicine hasn't worked before. Why is it going to work this time?
Well, that's all they have. I would absolutely agree. The medicine has not worked. QE1 was basically designed to rescue the banks. QE2 was to rescue the government, basically financing the treasury debt. And, you know, it's clear that the Fed is sooner or later running out of ammunition, but we still think that's the best shot they have unless they want to let nature take its course, and we have massive debt liquidation, which I think the Fed will not allow. So one way or another, they will probably come up with more liquidity.
Yeah, well, I mean, let me just put this analogy to you that a guest of mine said the other day, saying that, well, it's like giving more heroin to a heroin addict.
Well, that's what it is, unfortunately. But as I said, that's all they have. The problem is that we are in a very, very slow economy. And this is the characteristic when you come out of a credit recession or a balance sheet recession. Recoveries tend to be very slow. They take years. And again, we have to make this distinction between a balance sheet recession and an inventory recession. Inventory recessions last between 6 and 9 months. And if you ease monetary policy, we go back to normal. This is not the case here. So what we need to see is debt liquidation. Now, either you repay that or you default on it or you print it away. It's only these 3 possibilities. And it seems to me that the Fed is opting for the latter.
Yeah, well, you know, you mentioned the word debt, and of course that brings me nicely to the debt crisis in Europe. And we seemingly, it's all hunky-dory now, and Greece has been sorted out, but it hasn't really. It's just been postponed, hasn't it?
That's right. It's another attempt to kick the can down the road. Financial markets like it. The euro exchange rate is going up. So that's, and again, another quick fix, a short-term quick fix. In the long run, Greece remains a basket case, and we think that a debt restructuring is inevitable. It's just a question of, it's not a question of if, it's a question of when. The big question will be, will the debt restructuring be orderly or will it be disorderly? And that largely will depend on the ECB, what the ECB comes up to. The problem is the ECB has been dead set against the debt restructuring for good reason, because they are loaded with Greek debt on their balance sheet, and they have extended loans to Greece in exchange for very questionable collateral. So for the ECB, there's quite a lot to lose. But we think that an orderly restructuring, when you, for instance, lengthen the maturity of the debt without chasing the face value, will probably be an option that they might be willing to look at, but unfortunately, they're going to postpone it again into the future, which of course will increase the risk of contagion.
Yeah, and of course they call that reprofiling, don't they, of the debt? Okay, well, this brings me on nicely.
Well, you know, you can invent any term you want, you know.
But brings me on nicely to talk about, well, you know, where should you be putting your money? I mean, I think you like Chinese equities, and they seem to be out of favor amongst Chinese investors, to say the least. But you're suggesting it's a good time for them.
Well, I think the fear at the moment is that the Chinese economy is slowing while inflation is still rising. And I think the fear is that the authorities might overdo the tightening. There's going to be another interest rate hike, probably another hike in the reserve requirement ratio. But we think the fears of Chinese economy slowing are overdone. I think a lot of people have highlighted the fact that M1 and M2 have been slowing over the last 1.5 years. And that's probably the major reason why these fears of a slowdown have come up. We think China is different camp because in China, the authorities have the ability to turn the liquidity tap back on. And China has been the only country in the world where quantitative easing has actually worked. That has had an effect on the real economy because loan growth was there, which, for instance, in the United States, it was not. So we think that if you have a growth scare in China, it gives you another opportunity to go into Chinese equities because valuations are relatively inexpensive and portfolio managers are sitting on a lot of cash. So we think in the second half the Chinese market will perform.
Right, so let me ask you, Hans, right now with the prices, what is actually being priced into this, into the Chinese equity market? A hard landing, a slowdown, what?
Well, again, the pullback that we have seen in China is indicative of fears of maybe a hard landing. And, you know, I mean, you can make a case for that. But as I said, we are not in that camp. We think that it's a slowdown, not more than that, and that the liquidity tap can be put back on. So that's, for us, we look at this as a buying opportunity.
Hans, thanks so much for that. Hans Goetti there joining us from Singapore, just talking to us about, well, a broad swathe of issues where you should be putting your money and indeed what the problems of the US and indeed Europe as well.